Welcome to Course 3, Unit 5/Lesson 5, using a stock screener. Okay, in this lesson we're just going to be going over something that's really basic, easy to use, not all that complicated. And what it is it's called a stock screener. I prefer the Google stock screener over pretty much anything else out there, so that's what we're going to use for this lesson. So if you just go to Google and you type in Google stock screener and you hit enter, it should come up as the very first item. And if you go ahead and click on that, it'll take you right here to this stock screener that Google has available. Okay, now the purpose of this stock screener is you're able to change the criteria. So like this very first criteria is the market cap. So this is the size of the equity of the business. As you slide this bar to the right or the other one to the left, okay, what you're doing is you're changing the criteria of companies that fit into that specific criteria. And so we can add more criteria here, and then we can narrow down to get exactly the type of companies that we're looking for based off of their financial terms and ratios. So whenever I look at this, these are the numbers that I typically look for, and I'll give you reasons why as we go through this. But as far as market cap, I'm pretty confident that anything over about 100 million is something that is a company that's going to be a little bit more stable. And to be honest with you, at 100 million, that's still considered a small cap company. So our next criteria that we can adjust here, and as you can see, we're down to 1,836 companies that are currently in our criteria here. Okay, so as we adjust this, the price to earnings ratio, and as you remember, we want that to be below 15. Now, something neat about the Google stock screener is they show you the average of all the different companies in there and how many fit at those current ratios. So you can see how the little chart peaks out right at about 15 on the PE ratio, which is kind of ironic because that's what we're trying to find, anything under that 15 mark. Okay, so we put 15 in there and anything underneath of that. Now, whenever the PE ratio would be 0 or below, that's going to be a really bad thing because that typically means that the earnings are negative. And that's what we really want to stay away from, is any type of company that's going to have negative earnings. So this number here, I'd probably change this to about 4 or 5. That's up to you how you want to put that in there, but we'll leave it in at 4 for right now. Okay, so the dividend yield. And as you look here, how many companies we've narrowed it down to, just off of those two criteria, we're already down to 837 picks that meet that specific criteria. Okay, so the dividend yield. On the dividend yield, for the current market condition, about 7% is about the only thing that you're going to get that's realistic. Now, back in 2008, 2009, whenever the market crashed, I had this dividend yield clear up to 12, 14%. And the reason that I had it so high is because all the prices of all the stocks were so low. And if you remember how we calculated the dividend yield, it's nothing more than taking your dividend rate and dividing it by the market price. So since that market price was so low, I was expecting a higher dividend, and I was expecting the company to be able to actually sustain that dividend payment. So back then, you were able to really get some great picks with some incredible yields that were sustainable. But now, based off of where the market's at, you're going to be lucky if you can find anything even close to 7%, and that's a sustainable number. So we'll just put that in to see what happens. And then the dividend yield on the low end, I typically like to see something that's at least a 2% dividend. So I'll put that in as my low criteria, and you can see that it now narrowed our companies down to 457 companies. Okay, this 52-week price change I really don't care about, so I'm just going to delete that and get it off the board. Now, what I can do is I can add more criteria. So let me click on this tab here, and you can see they have it broken down into all these different criteria. So here's one that I like, which is the price to book. So I'll go ahead and click on that, and I'm going to add that criteria. Now, the reason I like the price to book is because that tells me my margin of safety. And if you remember, we're trying to find a price to book that is below a 1.5. Okay, so we'll move the slider down, and you can type in the exact number that you might want right there. Okay, so I put 1.5 in as my top criteria. And as far as the bottom criteria, I'm gonna just put in 0.6. Okay, and you can put whatever whatever you want in there to see what you kind of come up with your different picks. But I know that if a company's trading for a price to book lower than a 0.6, it's probably not going to be a good pick. It's probably going to be trading down there for a reason. Okay, so as we go to our next criteria, let's just see what we got here. So we'll click on the price tab. Okay, and the reason I'm not going to click on this EPS is because I'm already kind of filtering that in here with the PE ratio. Because if you remember, the PE ratio is nothing more than your price divided by your earnings. And to filter results just off of the EPS, you could have a company that doesn't have a lot of shares, and so the EPS would be really high, or you could have a company that has a lot of shares, and so the EPS is going to be lower. So that's not something that you can relatively measure. Like if a company has an EPS of 5, it might be just as valuable as a company that has an EPS of 1. So that's why I don't really particularly care for putting the EPS in there. I would much rather use the PE ratio because I'm comparing it to the price. So all these other ones, I'm not really interested in those. As I go to the valuation tab, we already got the PE ratio in there. If you wanted to, you could put the forward PE in there, but that's I'm not a big fan of that because I'm not really sure which price they're going to be using when they compare it to the future earnings. So I just use the current PE, and then I look at the estimates for future earnings after I kind of sort out which companies I'm particularly looking at. So as we go down to the dividend, you can see that there's some more different dividend metrics that we could put in here. I'm just going to stick with the current one that we have in there, which is the dividend yield percent. As we go to the financial ratios, now this is one that I particularly like. I like to look at the total debt compared to the equity for the most recent quarter. So that's this bottom one. Okay, and we'll go ahead and click. We'll go ahead and click on that. Okay, so for the total debt to equity for the most recent quarter, I'm going to put in here anything under a 1.0. Now, whenever we were figuring out the debt to equity ratio before, we weren't using the total debt. We were using maybe just long-term or some other different metrics. So there's a bunch of different ways to measure the debt to the equity, but for me, I'm going to use the total debt to the equity, and because of that, the max is going to be a little bit higher than the 0.5 that you're going to typically pull off of one of them top-level pages because they're not using the total debt. They're using just anything that's actually listed as debt off of the balance sheet, which I showed you in the previous lesson. So we're going to put 1.0, and if it goes down to 0, that's wonderful because that means the company has 0 debt. Okay, so the other metric I like on here, which I kind of skipped over, is the current ratio. So this is one of my favorite ones. We'll go ahead and put that in there. Okay, and for the current ratio, if you remember, if we have a current ratio of 1, that means we're going to have just as many current assets coming in as current liabilities flowing out in the next 12 months. So for this number, we're looking for something that's going to be over a 1.5. Anything over a 1.5 is going to be great because that means we're going to have a lot more money flowing in that's actually than what's flowing out. Okay, so we put that criteria on. Now, as you can see, as I'm going down through these criteria, I only have 12 companies right now that are meeting the specs that I've put in. Okay, now let's say that you're putting in some really stringent specifications here, and you have 0 stocks that are showing up. So what you're going to have to do is you're going to have to come up here and you're going to have to adjust some of these and be a little bit more lenient on your criteria. Now, as the market continues to improve and the market starts to climb and people are valuing a lot of these stocks maybe a lot higher than what they're actually worth, these criteria are going to have to open up and you're going to have to have a larger spread in order to start getting something that's within the zone that you're looking for. Now, if you just experienced a major crash, you could have all these criteria really tight to exactly what you're looking for, and you're probably still going to be able to find companies in there, which is great. And that's one of the most important times to be using it is during one of those kind of scenarios. So, okay, back to what we were doing here. So let's go to the next tab here, some operating metrics. And as you know, I'm a huge fan of return on equity. And so return on equity 5-year average, that's something I would really like to see, okay? because that's going to show me a company that has consistently been able to reinvest their money, and they've been able to do it over a long period of time. So that's something that we're looking for here. So let's go ahead and put in about 7%, 5%, anything above 5% is going to be something that I'd be interested in seeing, but 7% would be awesome, anything above 7%. So we're going to put that in. Okay, and now we're down to 6 companies. Okay, and then what also I'm going to do is I'm going to put in the return on equity for the most recent quarter. So we'll also put that in at 7%. Okay, and when we put that in, we still have 6 companies left. As far as the other metrics on here, they're not metrics that I'm really particularly interested in to get just a general overview of what companies out there meet my specs that I'm looking for. And so when we look at this list, you can see that we have 6 different symbols that we could then look up. So if you want to look up AVX, you could then dig into that company a whole lot more. I would never, ever invest anything based off of just pulling some symbols off of a stock screener. This is a tool that's just going to get you in the ballpark. It's going to be something that provides you some useful information as to where to start looking. So I hope this was informative. There's other metrics in here that you can play around with. Some of these might mean more to you than what they mean to me, and I highly encourage you to kind of develop your own strategy. But this is something that I would use as a starting point, the ones that I showed you. And from there, you can take it and just run with it. So I look forward to seeing you guys in the next lesson, and I really appreciate your support.